We had a question about bonds in a portfolio, bonds in an investment portfolio. You'll have stocks and you might have bonds. Typically, we don't hold real estate in a portfolio. But a lot of times what happens when you have a period of time when an asset class underperforms or doesn't do as well as you think it will do, a lot of times people are tempted to move more money to another area that they think will do better. So it's a general definition of market timing. It's tactical asset allocation, and we avoid it like the playground here. What is the idea behind bonds in a portfolio? Well, I want something that's stable in the portfolio or something that has the ability to be more stable. They're not always stable. Bonds can have volatility and risk of their own. Markowitz won the Nobel Prize for Economics for coming up with this idea of the efficient frontier. And you have on one side, you have risk and you have return. Now return here on the vertical axis, risk over here. And as we go from one side to the other, we're increasing the level of volatility of the portfolio. That's what he meant by risk, is how much up and down do we see in the portfolio versus the expected return of the portfolio. Now, what we would expect is as we take more risk, we would get more expected return. But what a lot of people don't notice about the efficient frontier, it was a curve that actually went out, and then what it did is it started to drop off and it didn't increase as much in value as you went from left to right. From my perspective, I guess if you're looking at it from the camera's view, it'd be this way. And what happened is that as you added more stocks and you dropped off bonds, the return expectation went up, but it didn't go up as much because you actually lose rebalancing ability when you add all stocks, because the only place we'll get real actual negative correlation where things move opposite each other are with stocks and bonds. Stocks have in different asset classes a positive correlation, meaning that they move together. So sometimes when markets go down, all markets go down. Now, there are times when they do move in opposite directions, but actually it is more often not they do tend to move with each other, but to different degrees. You may have one asset category that goes up 10% and another one goes up 20 or 30% in an upturn, and vice versa. They can go down differing degrees. So the idea behind the bonds is we want to have different types of durations in the bond portfolio. Now, duration tells me a little bit about how the bonds are likely to respond or how they will respond with interest rate increases or decreases. With a long duration, let's say we have a 20 duration bond. That means that if interest rates go up 1%, those bonds can drop 20%. So that's why we avoid very long bonds in the portfolio. We will take on intermediate risk, though. We'll take on bonds that have a 6 or a 7 duration. And if you look at what I have in my own portfolio, I have durations as high as about 6. Now I have durations as low as 0.3, so a very, very low duration, so very little interest rate risk. Well, why do we want both? And why do we want to have some cash in the portfolio that is just going to be paying a tiny, tiny amount of interest, and that's it? It's because no matter what the duration, you can have those bonds go down in value if interest rates go up. So we want something that can't go down in value because we may need to pull money out at any point in time, and we don't want those bonds down at all when we need to pull money out. Now, the longer duration bonds, what happens when you have big market downturns, if the stock market drops a lot, your bonds with a longer duration, typically what you'll see happen is interest rates go down. And when interest rates go down, those bonds will go up by the duration. So if interest rates go down by 1% and it's a duration of 6, they will go up 6%. Or if they go down 2%, they'll go up 12%. So you look at that and go, wow, there can be some big dissimilar price movement versus if you put all your money in, let's say, CDs or something that's just going to pay the interest rate that's being paid. So when we see big market downturns from the past, a la 2008, 2002, you'll see that the bonds, the longer term bonds or the longer duration bonds jumped a lot. And that is why the Markowitz curve, from my perspective this, from your perspective this, evens out and flattens out, because when those bonds go up and when they've gone up in value, when the stock market goes down, what happens is that allows me to sell some of the bonds and buy some of the stocks. And what's the golden rule of investing? Buy low, sell high. So hence, we want different durations because they will respond in different ways. There are times when interest rates, let's say they go up and bond prices go down and stocks go down as well. We saw that recently. That's exactly what happened. That's why we don't put all of the money in the longer duration bonds, because they can go down together. This is the idea of diversification. Lots of different asset categories, stock asset categories, but also different types of bonds, different durations, but making sure that the bonds are not terribly long in duration, and also making sure that they have incredibly high credit quality. In other words, we don't want somebody that could default on the debt and we end up losing that. There's always a risk of default with any type of bond. But the reality is, if we hold those higher quality bonds, the likelihood of that happening is much, much slimmer. So typically we keep up in the A range, in A, AA, and AAA types of bonds in the portfolio. So we don't have that type of risk, because we want the bonds there for what reason? Stability of the portfolio. But recognize that if we go and forego those bonds and we go all stocks, historically the expected return differential isn't nearly as much as we might think when we go from, let's say, 75% stocks to 95% stocks. It's a very small incremental increase, and that's what Markowitz pointed out in his Efficient Frontier. Why? Because of that rebalancing and the effect that that can have on the portfolio. So I hope that answers that question. Thanks a bunch, and any kind of questions you have, paulwinkler.com/question, or you can go on the website, paulwinkler.com, and ask questions right there.